Good morning. You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
Good morning. Welcome back to Insurance Matchmaking. Crazy weather. Last week, we're talking about how cold it was, and I didn't go to the office that day. I recorded that show. That was a snow day, and it wasn't too bad on the main streets, but I knew nobody was going to come to the office, so I came over and recorded my radio show, and then went back home and worked from home that day, and then actually the next day I went in a little bit late. And then today, as I'm recording this, they're saying we may have a record high for this date. So it's funny how, from one week to the next, how much the weather can change here. The old saying, you don't like the weather, wait 10 minutes, it'll change. Or the 4 seasons in one day. We're used to that in East Tennessee, or Tennessee in general. I'm sorry about kind of a little slip up there. Spent too many years living in East Tennessee, and always say in East Tennessee instead of saying Upper Cumberland or Middle Tennessee. And you guys know I'm a transplant, but Cookeville is home now. I love it here. And so just kind of wanted to touch on some things. I've been noticing some weird things when I'm working with clients. They're getting quotes, things being presented as being health insurance and their insurance, and they're similar to policies that I write, but I've talked about those fixed indemnity plans or the fixed benefits. They're not bad plans. The only thing that bothers me on that is especially when they're talking to a telesales agent, and sometimes I think the agents they're talking to don't really know, because that's what they were trained to sell, and they're presenting it as major medical, and it's not major medical. It has a cap, and I sell plans that have cap, but I also inform my clients of, hey, this is a great plan. It's going to pay a lot for coverage, but something catastrophic happens, it may not cover it all. You could hit the maximum coverage for that plan. So as long as you're aware of that, these plans are great, because a lot of times most people figure, and again, rather than have no insurance, because that's unfortunately a lot of my clients will choose that I never go to the doctor. This insurance is just too expensive. I'm just going to pass. Well, I never recommend that. And it's not just because I want to make a sale. It's very dangerous to go without insurance. Same thing, with not having car insurance. I can remember when car insurance wasn't mandated, and you kind of worried. You made sure you had a hefty uninsured motorist coverage on your car because you didn't know who might hit you. And it's still a problem, but not as bad since they've mandated that you have to get insurance. I don't know, Tennessee may not be as good at enforcing that. When I lived in Texas, it was kind of, I don't know how anybody could drive in Texas without having insurance, but they've cut back on some of the things, that were enforcing that. But, they had a state inspection, safety inspection you had to get on your vehicle. And I don't think it was every year. I don't remember what the time frame was. Every 2 years, every 3 years. I was only there a short time. And the car that I bought I bought a used car from someone, and it already had the sticker on it, so I didn't have to redo the inspection on that. But to get the inspection, and usually would do that at a gas station or an oil change or some type of mechanic shop, and you had to prove to them you had car insurance, or they couldn't inspect your vehicle. And then when you went to register, when you go to register, you have to transfer that title. You have to be able to prove you had insurance. The crazy thing was, I was talking to an insurance agent. It's like, you had to prove you had insurance. And I'm kind of like, how do I do that? I'm buying the car. So it was really an interesting concept. And I know, and car insurance isn't what I do. That just kind of popped in my head this morning. But you don't want to go without homeowners insurance. We've had a couple disasters this past year. Within the last 6 months, like say in the past year, because it was this year, the fires in California, and then the Hurricane Helene hitting East Tennessee and in North Carolina and some other areas too. But, people lost everything. And I'm sorry that I'm kind of almost like laughing, but they lost everything. And, hopefully most of those had insurance, to recover that loss and maybe be able to rebuild. And they may have to rebuild somewhere else, but hopefully they had some insurance to cover that. If not, they're just starting over from scratch. You don't want to do that with your health. The leading cause of bankruptcy still in the United States is medical debt. And one of those things I learned, years ago when I started with Aflac, and I'm trying to see if I can remember the numbers correctly, but it was like 60% or 65% of bankruptcies were due to medical debt. Like I said, the numbers may not be right. 75% of those had health insurance. They didn't have the stuff to fill the gaps. So that's those accident plans, that short-term disability that'll pay you while you're out of work so you can keep your bills paid, critical illness plans, things like that. And those are things, we offer all those things. A lot of times when I'll talk to somebody, say, oh, you mean like Aflac? It's like, yeah, but you don't have to go through your employer to get it. Now, if you have those plans, I always recommend, it's like, hey, if you got to keep those, I can't beat the rates. When you get those plans that are through payroll deduction, they're much lower rate because they know they're going to get paid because it's coming at, your employer's paying it. So they'll offer you a plan for a lot less because the claims on it aren't that much. I mean, they have so many people insured that they're basically, when they do have to pay out a claim, they're still ahead. So they're fine. They're fine with offering those for a low payment, low monthly premium. And the other thing is, somebody gets a plan like that, they get it through their job, they pay religiously on it for 6 months, a year and a half, and then they move and they go to another job, and they never filed a claim any time that was coming out of their paycheck every week. But they never had to pay out, so they made money on that person. So that's the odds that they're figuring, is they're making sure that, so they do those very cheap. I can't get them that cheap. I can still get them fairly inexpensive. I've got a plan right now, a cancer plan, that even people that are in their 60s, I can get them $10,000 of cancer coverage for less than $25 a month. Most of the time, I'm usually say, it's a dollar a day, get you $10,000 of cancer, and that's usually kind of average, that $30 a month for $10,000 cancer. This one company I have, it's a little bit lower, and it pays out a lump sum. It also, now, of course, you can pay a little bit more if you put in. There's some other, there's options you can add to it. You can have a recurrence benefit, because usually the way those cancer plans work is once you're diagnosed with cancer, you send in the paperwork that shows that you were diagnosed with cancer, and they just send you a check for the amount. And then you stop paying the premium because you filed a claim on that policy and you're done with it. Some of the plans have where you can have a recurrence benefit. So you would keep the plan going, and if cancer comes back, say in 5 years, it pays again. So those can come in very handy, be very inexpensive. I definitely recommend those for my Medicare clients because of the cost of, if you've never had cancer, the chances of it happening as you get older get higher. And that's the great thing, those plans, if you get them younger, they're much less expensive. In those type of plans, the rates don't go up. So that's something to look at. And again, those are some things that can fill the gaps of some of those plans that don't cover much. I always recommend those. I got some people think it's ridiculous to get a plan that's a $10,000 or $25,000 deductible, but having that plan is better than, the plans are just too expensive, I'm just going to take my chances. Well, you're going to pay for your health care if you don't have insurance. So even if the plan doesn't come with co-pays, you've got something that's going to protect you from having a $200,000 medical bill. Now, you may have to pay $10,000 or $25,000 because that's your deductible, but I would much rather owe the hospital $10,000 than owe them $100,000. So, you do the math. So that's one of those things. People, when they look at, I want coverage. Well, they want coverage just like they had through their employer, which, in the past, those were great plans. A lot of people didn't pay anything for their health insurance, or they paid $25 a week, and their employer paid the rest. And they had a $10 copay for the doctor. They had a $5 copay for their prescriptions, $1,000 deductible if they, went in the hospital, something like that. Those were great plans. Those costs have gone up. Thank you, Obama. Sorry, it's true. Obamacare raised all of the health insurance premiums because when you mandate things, the premiums go up. I'll go back and illustrate car insurance. Remember how cheap car insurance was before it was the state required you to have it, how much your insurance went up after that, because they knew they could charge more because everybody's going to have to get it. So that's the way it works on that. And like I said, having no insurance is really just not a good idea. If you have something with a high deductible, or like I mentioned, the fixed indemnity plans, they'll pay so much for a doctor visit. They'll pay so much for a surgery. If you have an accident, and there's different kinds of accident plans. The other thing, the beauty with accident plans, they're guaranteed issue. And you've listened to my show, you're probably familiar when I talk about guaranteed issue. You can't be turned down for that plan. Now, the one thing with the accident plan, and it doesn't matter if you just broke your leg. You can still get an accident plan today if you broke your leg yesterday. Now, it won't pay for anything to do with that broken leg you already have, but hey, you're walking on crutches now because of the broken leg, and you stumble on the stairs and now you break your arm. It'll pay for the broken arm because that happened after you got the policy. So that's one of the neat things about having guaranteed issue. And then some of the plans, some of the hospitalization plans and things like that, you can also get guaranteed issue. What happens is on those is they're not going to pay for a pre-existing condition, or they may never pay for a pre-existing condition, or sometimes there's a waiting period of 6 to 12 months before that plan would cover something related to that. So even if you're not in the best of health, there are plans that you can get to help cover those big out-of-pocket expenses. And that's one of the things I try to share that with my clients. And it's like, I know sometimes I think I'm getting better at it. But when it's brand new, you feel like, I'm just being too pushy. They're just going to get upset because I'm trying to put too much on them. And I'm really trying to make sure you have a complete package of protection, because that's what insurance is. Insurance is the exchange of risk. Instead of you risking your hard-earned money and your savings to cover a catastrophic event, you're putting that burden on the insurance company. A lot of times I'll run into that. People will talk about, well, where's my card? And it's like, well, you don't get a card with it. With most accident plans, most like critical illness plans or hospitalization plans, you're not going to get a card to present to the doctor's office or the emergency room when you go there, because it's an indemnity plan that pays you. You have to file a claim. Now, here's the beauty on that, is you have to have a bill to do the claim. You don't have to pay the bill. I mean, you're going to have to pay the bill, but eventually. But let me coming up on the break here. I'll address that about paying the bill and the claims right after the break.
Need a little help with home repairs? The Habitat for Humanity Critical Repair Program is here to lend a hand. We're accepting applications now through February 14th for non-emergency repairs like plumbing, roofing, and more. Visit uchabitat.org and click the Critical Repairs Program tab to apply, or stop by our office at 1546 East Spring Street, Suite B. Don't wait. Applications must be postmarked by February 14th. Habitat for Humanity, helping you make your home a better place. Equal opportunity provider. Discrimination is prohibited by federal law.
Hey Tennessee, planning a home project, whether planting a tree or installing a fence, don't dig yourself into trouble. Underground utility lines could be just inches below the surface. Hitting one could mean costly repairs, service outages, or serious injury. Avoid risk. Call 811 before you dig. It's fast and free. Stay smart, stay safe, and call before you dig. Brought to you by Twin Lakes.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right, welcome back. I was talking just before the break about the claims with the indemnity plans, and I made a comment. You don't have to pay the bill, and it's like, well, you don't have to pay the bill before you get the claim, or before you submit the claim. Is what I was trying to say. But you need the bill, and usually most plans are going to say they want an itemized bill, and you can contact the billing department at the doctor's office or the hospital, depending on where you went, and request an itemized bill, because just the bill they mail you in the mail may not have all the information that you need. But when you ask for the itemized bill, it has those billing codes, and it's those billing codes that the indemnity plan insurance company looks at to make sure you qualify for your benefit payout. So get that bill, I mean, sometimes, or sometimes when you're like, if you're in the hospital and they say, hey, if you pay the bill today, we're going to knock 10% off. And you may want to do that. And if you can give them your credit card, if they'll take your credit card for it, and depending on what your billing cycle is on your credit card, you could get that and then request the itemized bill, submit that itemized bill to your insurance company for your benefit claim, and have that money before you actually have to pay the credit card bill. So, or if you're one of those that doesn't always pay your credit card off every month, you might accumulate a little interest on that hospital bill, but within the next month you should have the money from the claim and pay it, and you don't have to pay it off either. You can pay the bill off in whatever time you want. You can use that money that you get from your claim to pay whatever you want to pay. It's your money. It's just like, your paycheck. You don't have to necessarily use your paycheck to pay your medical, your hospital bill. That's up to you. You pay your bills as you choose, but the money goes to you. Now, there are some plans that do allow you to assign benefits, and when you do that, then kind of it's on the hospital or the doctor to file the claim for you. That happens more on dental plans. That's where I always tell people with the dental plans, they're all the dental plans I write are PPOs. I mean, I guess there might be a couple that are HMOs, or you can only there's a copay plan that from one of the companies offer that I think with the copay plan that the dentist has to be in network for that plan to work. But most of the plans they're PPOs. They're technically an indemnity plan, but even if the dentist isn't in network, like I said, this happens more with dentists. The dentist will usually file the claim for you and say, okay, your insurance is going to pay this much. This is how much you need to pay today, or this is how much when they send you a bill of that balance. Because again, if the dentist isn't in network, they're not going to cover as much as they would with an in-network dentist. So the beauty there is you don't have to be in network, but you are going to pay less if you go to a dentist that's in network with your insurance. So a lot of times they'll say, well, my dentist doesn't take it. Well, they may take it, but they're not taking it as in-network payment. So you want to clarify sometimes if that is, you're not in network where you still file the claim with the insurance company. And if not, you can pay your dental bill, get your, have your receipt, and then submit your receipt for your dental bill. Again, you need those dental codes. And submit that to the insurance company, and they will reimburse you what they would have paid a in-network dentist. So there's a PPO plans. They will pay claims. It's just they may not pay the dentist. Now, there are a couple of plans that are those, what I talked about, the fixed indemnity or the fixed benefit plans that will pay so much per doctor visit, so much for an urgent care. And those, a lot of times you'll get a card, and you can present that card to the doctor's office. They may know what to do with it. They may not. They may be in network. They might not. It's still going to pay whatever amount it says it can pay, but it may be paying you and not the doctor. If the doctor files the claim, then they pay you. And then what happens there is, like, say it's $50 doctor visit is what that insurance will pay. And if the doctor says their copay is $35, and the insurance company will pay them the $35, and they'll send you a check for the $15, because they'll pay out the benefit, but the benefit doesn't always have to go 100% to the provider. It depends on how much the provider bills and how much your benefit is. Now, if it's a surgery and they bill $1,800, but it was going to pay $1,500, you're going to have to come up with $300 to pay the doctor. Or sometimes the doctors, again, sometimes they'll give you they'll write it off because they're getting what's paying the insurance is paying. So you always want to make sure that if you can file that claim through the doctors, you want to do that. But like I said, you won't always get a card with a supplemental plan. The other thing I mentioned, those high deductible short-term plans with the $10,000 or $25,000 deductible, and generally on those plans like that deductible is also the maximum out of pocket. So boom, you just if you hit that, it's going to be a $10,000 bill. A lot of times though, also those plans will have a copay for the urgent care. And it might be $45, but that's still about half what you would pay if you just cash paid at the urgent care. So it may not pay anything for your primary doctor. They're not going to cover, preventive stuff like your women's wellness visit, mammograms, prostate checks, colonoscopies, immunizations. Most of those plans are not going to cover those preventive things. They're just basically a catastrophic plan that you have. You just like I said, you're spreading that risk. You're sharing that risk with the insurance company. That if you have a $100,000 hospital bill, it's only going to cost you 10 or 25. And I know I say only. Yeah, that's a lot of money, but it's still, it's a lot less than what that bill could be. So it's a good idea to have those plans. You probably, with the $25,000 deductible, probably save about $100 a month premium versus that $10,000 plan. So these plans can be very handy, especially for folks that aren't going to qualify to get the subsidy or a decent subsidy on the marketplace plans, and that's kind of what we're expecting to see. The higher subsidies and the higher max income, those were all things that are going to sunset at the end of 2025. Now, the Trump administration could surprise me and go ahead and continue those, but the conventional wisdom is we aren't expected to. And that's one of the reasons why I actually have looked into possibly going with Medicare and being able to offer that to my clients. They do have some great programs. Again, you might have a big out front, and they have actually what's neat is they don't call it a deductible, they call it the family share amount. I think I'm saying that right. The neat thing with those plans, though, it is the family. It's not not double it for the family deductible or whatever. It's whatever that annual share amount is set. So it may be $3,000, it may be $9,000, but that's for the whole family. And then they do have some plans that you can add in to get some of those preventative things, have some copays for sort of prescriptions and doctor payments. So it's an additional fee. But it's like you can take that higher share amount for the catastrophic stuff and then supplement it with this other plan and be less than going with just the lower share, because you're like, well, I'm never going to hit $12,000. I want to do the $3,000. But you can add the other plan and do the higher amount. And again, I'm butchering the training on that, but that's something I think I'm probably going to go ahead and sign up and offer that to my clients. I've been a little leery about the health sharing plans. I had one in the past and had an issue with a client's claim on when it wasn't Medicare, it was another carrier. And so I've been a little gun shy when it comes to the sharing plans, but I think this might be a good option. Again, I want to have options for my clients. The short-term plans are probably going to be there, but they're not the best option for everybody. And then the Medicare, the sharing ministry plans aren't the best for everybody else either. One of the drawbacks on that is if you're a smoker, they're not going to take you if you use tobacco. So there are there's some restrictions that not everybody can get it. Just having a pre-existing condition is not a knockout, whereas that is usually with the short-term plans. But they're not going to cover anything related to that pre-existing condition for the first 3 years you have the plan. So you have to determine whether that's going to be worth it or not, or do you need to go through the healthcare marketplace because of your pre-existing condition, and you're going to pay more. Now, the other thing is on that, I recommend families that maybe there's one family member that can't qualify health-wise, but the rest of the family does. I do have one family like that they had the 3-year short-term plan with me. Unfortunately, and sometime I think in the second year or maybe early in the third year, the mother developed breast cancer. Now, they covered her for her breast cancer, but at the end of that 3 years, she couldn't continue with the plan because now she had a pre-existing condition. and the rest of the family went ahead and went on that plan. So it can still be a thing. The whole family doesn't have to have the same plan. We usually try to do that, especially, mom and dad and kids. We try to get everybody on the same plan. And a lot of times with the marketplace, depending on their income, mom and dad get a Affordable Care Act plan, and the kids end up on TennCare or CHIP, the Children's Health Insurance Program. And so there's a couple different ways that, they end up on different plans. And then they get their dental and everything with that. And I've had families that have bought a family dental plan because they couldn't get a dentist, or they couldn't go to the dentist they wanted to because that dentist didn't take TennCare, or the marketplace has to provide you dental and vision care for children, but it's basically just the preventive care. It's not a full comprehensive dental. In the vision, I think it covers the eye exam, doesn't cover the eyewear. I'm not positive, but they're not robust ancillary plans. So they have some coverage, but you may still want to get a separate plan for the family for dental and such. So those are some things to look at. And again, if you're not wanting to go through the healthcare marketplace, or because of your income, it just doesn't make sense, we do have options. And the other beauty is with the short-term plans, and of course, as I mentioned, the sharing plan, if I start offering that, there is no enrollment period. You can enroll in that today. You can enroll in it tomorrow, next week, or a month from now. As long as your health is good enough to get that plan, you can sign up for it. It's not a matter of, I missed the open enrollment. So those come in. I've got some people that taken short-term plans because they missed the open enrollment and didn't qualify for a special enrollment to get it. So those are some things we can help you with. Just they're not the best for everybody, but they can be great for some. The other thing is, right now I can write a 3-month short-term plan with a 1-month extension, so it covers you for 4 months. Hopefully here in the next month or so, that restriction that was put in during the Biden administration will be removed, and we can go back to selling those 3-year short-term plans. And when I say the 3 year, because they're still 1-year plans, but you don't have to go through the health underwriting for year 2 and year 3. At the end of year 3, if you reapply for again, that's like the family I mentioned just a few minutes ago, you do have to health qualify to be able to renew it after the third year in. So that's something to look at. So again, we'll talk to you next week. Remember, at Matt Libby Insurance, we can cover you from head to toe. It doesn't have to cost you an arm and a leg. And don't forget to go to insurancematchmaking.com. You can listen to my past shows. They're on YouTube. Please like and subscribe and share those YouTubes, and so get the word out so more people can get to know me. And have a great week, and we'll talk to you next week.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.